afternoon, everybody. Welcome to the podcast. Thank you for joining me. Well, the markets have about an hour to go before they close, and just wanted to get this out to you and give an update. We've seen a nice little bounce off of the 50-day moving average, and the last couple of weeks we had said that, you know, if the market was going to bounce, this is probably the area it was going to do so, and you can see just by looking at the picture here the reason why. This is where it's been bouncing every time, which is real close to the 100-day moving average. I think some people use the 50 or the 200, but to me it doesn't really matter. It's what's working, and the 100-day seems to be what's working. So we said if it's going to bounce, this is probably the area. However, what we need to do is, number one, monitor the quality of the bounce, and then number two, one of these times that's not going to work, right? So you have to be careful about just saying, well, every time it comes down to this line, I'm going to go ahead and buy it. Because one of these times it will do this, it may bounce a little bit and then fall on through. You know, some of the gains in recent days has been attributed to the fact that there has been de-escalation, which I don't know if I necessarily see that. Seems like things are just as bad as they ever were over there in the Middle East. But nevertheless, the stock market has been moving higher, and you can see it did bounce off that area. And what we said was, if it's going to bounce, this is the spot it should do it. But we would prefer to see it really whoosh down so we can get an easier entry point. So, but again, it depends on how you're positioned. If you have a 100% cash, then you needed to buy that dip. If you were somebody that is mostly invested, then you didn't need to buy that dip. And what we need to see now out of the market is, can we cross through this old high, which is just probably 1% or so. I think we're maybe 0.75% below that old high. So, you know, if we do that, then we should see more gains to come. But I would caution you that, you know, we've seen, 6 out of the last 8 days have been up. So we should see some type of pause. But if we start to see a pause and it hanging around this area, you know, many of the bears will come in and say, hey, look, you know, we're reaching this ceiling here. But we haven't seen that just yet. But look, I think ultimately we will go higher. It's just we could see some, you know, still see some late summer turbulence, and we've seen that, haven't we? I mean, as we go through, really from, this is the peak back on July 3rd, so here we are on August 19th. We've had 6 weeks of really nothing. You know, we've seen some pullback, some gain, but really nothing, and that's the sideways nature that we're getting right now with all the news headlines and the fact that the economic data has been very mediocre lately. Now, we did get some positive housing data this morning, and so if you look at the home builders, you know, they're responding nicely today, which makes sense. Interest rates are still contained, still low. In fact, they've moved lower, which is a whole separate conversation. I think a lot of people look at this and say, look, if the economy was really that good, would we see interest rates continuing to fall? Partially this is happening because our interest rates are still higher than other countries around the world, so our bonds look more attractive to those people. So that's why they're buying our U.S. Treasuries. In addition, maybe the economy isn't that great. So there, and of course we have the headlines, you know, going across of everything going on in the Middle East. So when you put all that together, interest rates have been going down. Having said that, that's why you're seeing interest rates down, better home data coming out, housing data coming out today, and you're seeing the home builders get a little bit of a spike. But they have struggled since March. I mean, they're still down, you know, right now about 8.5% from their high. They were down 17% from their high. But, you know, overall, the stock market itself has recovered nicely. And, you know, again, it was a very easy market to get whipsawed in, especially down at these levels. So we did see a spike in the fear. We saw it come back in. That was a time to buy. If you were wanting to get more aggressively invested, that was the time to buy. But overall, this is the next spot people are going to be watching. Can it break to new highs? If it does, fantastic. The NASDAQ has already done that. The NASDAQ is at new highs as I speak, up about 1/3% today. So it's breaking on up. What we would expect, and most of you know this from watching this, is that we would expect a breakout, and then if it can come back and test that and hold that level, then we can have bigger gains. But overall, the rally that we've seen, there's been some impressive days, but overall it hasn't been real, you know, dramatic. What we really wanted to see, to be honest, is that we wanted to see a big spike down, and we saw really a pretty nasty day. We wanted to see a couple of those in a row, and then followed by a really, really strong day. We really didn't get that classic capitulation. and which we haven't lately, have we? I mean, all of these bottoms haven't been that classic sign that we see. So it makes it hard if you're wanting to, again, get serious money invested. But if you're already invested, there hasn't been a whole lot to do, frankly. So just kind of holding in there. So we still have a little bit of cash in our tactical portion, higher amount than normal. And again, we're watching this to see, does this thing fizzle out or not? And if it kind of pulls back, and then you get a rally on through the to make new highs, that would be fantastic. Now, if we look at the volatility index, we saw the spike. Once again, it didn't get as high as it had in the past, so we didn't get kind of the freak out session, but it was up there. But now here we are heading back down to the lows again. If we switch over to oil, this is something I think a lot of people are watching right now. This is as of yesterday's close, but oil is down again today. And you'll notice here as I zoom out, we're on support right now. So this is kind of a key level to be watching for those that are watching the oil market, because if it does break, we've got obviously lower prices to come, but we could see this thing spurt back up over 100, especially if, there's some more news headlines coming across the wires. If we switch over to gold, I've kind of drawn these three circles. This is your inverse head and shoulder potentially. It's not the prettiest picture, but I've kind of equated gold to Apple in the last several months, because we've got this and we have this now. So yes, these are big moves in here when it's doing this, but for the most part, this could be setting up for a bigger move higher. So let's watch that, because it's sloppy, I know, but let's continue to watch it, because at least gold hasn't been going down. And in fact, this year, if you look at it from January 1st, it's still been one of the leaders, up about 7.6% on the year. So bonds have been the best. Treasury bonds have been the best thing to invest in. Gold has been right up there, along with NASDAQ, and then you start coming down to some of the other indices. All right, that's really all I have, folks. I guess we could look at the Dow real quick, but for the most part, not looking too terribly. It's got a little bit more to go before it gets back up to its high. But for the most part, we're getting just this typical volatility we've been getting, but I'm not sensing from most of you. And I did do a discussion last week in the Houston area, and that crowd was not overly panicked about Dow 17,000. I don't think they were overly joyed about gobbling up as many stocks as they could. I think it's just more about ho-hum, let's see what happens type of attitude, and I think that's what a lot of people are doing right now. So, again, the path of least resistance for the market has been up, and it still looks to be up. There was some mild deterioration in, early on where we were seeing, junk bonds sell off, and by the way, you can see they've recovered quite a bit. Now, they're still underperforming the S&P, which is interesting, but you can see that junk bonds have recovered, but that was a concern. As well as, we'll just go to small caps. Small caps as well have been a concern, because they fell off about almost 10%, I think, from here to here. But they were lagging as well, and they've been kind of leading the last couple of weeks. I think since August 1st, they're actually outperforming the S&P. So those things have healed a little bit, but we still could see some choppiness. So, but look, the path of least resistance has been up, and probably will be up. So the majority of our equity money is invested and has been, but we would not be surprised to see some type of summer sell-off as we move along here. But again, until proven otherwise, until this trend here breaks, it's not going to change. And in fact, the managers on Wall Street right now, the big theme is that you're not really hearing a lot about is if the market drops 4.4 to 4.5% from its high, you buy. That's what the traders are doing right now. And why? Because, look, it's worked almost every time, and it will continue to do so until it doesn't. And how do we know it won't? Because when it gets down here and it doesn't bounce and keeps falling, then we'll know it doesn't work. So for right now, that's been the key. So again, the path of least resistance has been for the market to go up and for you to be invested with your equity portfolio. So that's what we've been doing. We really, through all of this the last month, I think there's only been one position we've actually sold, and it was a very small position in our tactical portfolio we got stopped out on. Other than that, we haven't made any major shifts because, frankly, there hasn't been any need to. So, all right, guys, thanks for joining me, and we will talk to you soon. Take care.